Dividend investing is an appealing strategy for generating passive income. But one common question arises: how much capital do you need to generate a specific amount of monthly income? Whether you're aiming for $500, $2,000, or even $5,000 per month in dividends, the amount you need to invest largely depends on several key factors. Dividend yield is the starting point for understanding how much you'll need to invest. It's calculated by dividing the annual dividend payment by the current stock price. For example, if a stock pays $3 annually per share and its share price is $100, the dividend yield would be 3%. Higher yields mean more income per dollar invested, but they can also signal higher risk. Stocks with yields above 5% might be unsustainable or from companies in trouble. Most experts recommend focusing on stocks with yields between 2% and 4%. This range balances income with safety, avoiding the risks of very high yields. High-quality dividend-paying companies, like those found in the Dividend Aristocrats and Dividend Kings lists, offer stability and consistent yields. Sometimes, a high yield happens because a company's stock price has taken a big hit, which could signal trouble. Always check if a high yield is sustainable before investing. Companies paying large dividends might face financial issues, leading to dividend cuts. This can disappoint investors relying on that income. The goal of dividend investing is to create a steady source of income while also growing your capital over time to beat inflation. The S&P 500's dividend yield is currently around 1.25%, lower than in the past, largely due to the increasing allocation to technology stocks. To generate $500 per month in dividends from a fund with a 3% yield, you would need about $200,000 invested. For $2,000 per month, you'd need around $800,000. Funds like Vanguard's VO may have lower dividend yields, but their long-term stock price growth makes them a strong investment choice. A higher dividend yield means needing less capital. For example, with a 4% yield, you'd need $600,000 to generate $2,000 per month, compared to $800,000 with a 3% yield. Chasing high yields can be risky. Stocks offering very high dividends might be financially unstable or could cut dividends during tough times. Reinvesting your dividends creates a powerful compounding effect. Your money works harder for you, generating more dividends over time. By reinvesting dividends, you build long-term wealth and increase your capital. The longer you stay invested, the greater the compounding effect. Receiving dividends can be a rewarding experience. It serves as a reminder that your investments are working, providing income even in volatile markets. Even when stock prices fall, dividend yields often rise, giving investors a boost of income. This can help provide stability during market downturns. Reinvesting dividends creates a snowball effect. Over time, your returns start to grow on top of previous returns, leading to exponential growth in your portfolio. Welcome to dividend growth investing. This strategy helps build a sustainable wealth foundation over time. Many investors wonder how to achieve financial independence, and dividend growth investing offers a solid pathway. In this video, we'll explore how this investment approach can help you reach your financial goals. A key benefit of dividend growth investing is focusing on consistent dividend increases. Companies that regularly raise dividends demonstrate financial health and commitment to shareholder value. This reliability provides a stable income stream, which is especially appealing for funding retirement and protecting against inflation. Compounding is a powerful concept in investing. When you reinvest dividends, they buy more shares, generating even more dividends. Over time, this leads to exponential growth in your investments. The longer you stay invested, the more powerful compounding becomes. When evaluating dividend stocks, consider key metrics like dividend yield, payout ratio, and dividend growth rate. A balanced approach ensures you choose quality companies that can sustain dividend payments while also offering growth potential. Finding the right dividend stocks involves thorough research. Look for companies with a strong track record of dividend payments and growth. Focus on sectors that are more likely to provide stable income, such as consumer goods and utilities. Managing risk is essential in dividend investing. High-yield stocks may seem attractive, but often come with higher risks. Striking a balance between yield and safety is crucial. Diversification across different sectors can help mitigate potential risks. economic conditions can impact dividend-paying companies. During downturns, some companies may cut dividends. It's important to analyze how companies performed during past recessions to assess their resilience in economic downturns. Dividend growth investing is not about quick wins. It's a long-term strategy. By focusing on quality companies and reinvesting dividends, you build wealth over time. Patience and discipline are your allies in this investment journey. It's essential to understand the tax implications of dividend income. Qualified dividends are usually taxed at a lower rate than ordinary income. Being aware of how dividends are taxed can help you plan your investment strategy more effectively. Dividend growth investing has long been a cornerstone of wealth-building strategies, particularly in the U.S., where the stock market has rewarded long-term investors with reliable growth and consistent returns. In the context of the American economic landscape, this strategy becomes even more appealing due to the nation's stable market infrastructure, diverse industry presence, and economic resilience. As the U.S. economy navigates through inflation, fluctuating interest rates, and technological advancements, dividend growth investing offers a compelling path for those seeking both passive income and long-term capital appreciation. 1. Why dividend growth investing is ideal for the U.S. market. The U.S. stock market is home to a broad array of dividend-paying companies that have historically shown strong resilience through market cycles. This makes it particularly suitable for dividend growth investing, where the goal is not only to earn income from dividends, but also to benefit from the growth of these dividends over time. Dividend-paying stocks are often large, well-established companies with strong cash flows, making them relatively stable during periods of economic uncertainty. In the U.S., companies in sectors like consumer staples, utilities, and healthcare tend to offer steady and growing dividends. The presence of dividend aristocrats and dividend kings, companies that have increased their dividends for 25 and 50 consecutive years, respectively, provides a foundation of reliability for investors seeking financial stability. Given the size and diversity of the U.S. market, investors have ample opportunities to diversify their dividend growth portfolios. From sectors such as technology, financials, and real estate to more traditional industries like manufacturing and consumer goods, the U.S. offers exposure to industries that can thrive in various economic conditions. 2. Current economic climate and its impact on dividend growth. The U.S. is currently grappling with multiple economic factors, including inflationary pressures, rising interest rates, and fluctuating consumer demand. These conditions can make traditional growth investments more volatile, but dividend-paying companies often fare better in such climates. While stock prices may fluctuate, companies that pay and grow dividends offer a reliable income stream, which becomes especially valuable in uncertain times. Inflation erodes purchasing power, and investors often seek out investments that can keep pace with or outstrip inflation rates. Dividend-paying stocks, particularly those that increase dividends annually, can help combat inflation. Companies that grow their dividends tend to have strong financial health, allowing them to pass on increased profits to shareholders, thus maintaining or enhancing income in real terms. Moreover, with the Federal Reserve's current approach to managing inflation by raising interest rates, fixed income investments like bonds may become less attractive. Dividend-paying stocks, on the other hand, can continue to offer competitive returns, particularly for investors looking for both income and capital growth. Unlike bonds, dividend growth stocks offer the potential for price appreciation while also paying out regular income, which can be reinvested to compound returns over time. 3. The role of dividend growth in retirement planning. One of the most compelling reasons for investing in dividend growth stocks in the U.S. is their role in retirement planning. Americans are living longer, and the cost of retirement is steadily rising. With Social Security benefits expected to face funding challenges in the coming decades, it is increasingly critical for individuals to create sustainable income streams for retirement. Dividend growth investing aligns perfectly with the goal of building a reliable income source during retirement. By the time investors reach retirement age, they may have accumulated a substantial portfolio of dividend-paying stocks that provide a steady stream of income without the need to sell assets. Furthermore, companies that grow their dividends are likely to continue providing inflation-adjusted income, helping retirees maintain their purchasing power. Tax-advantaged retirement accounts, such as 401(k)s and IRAs, provide an additional benefit for U.S.-based dividend growth investors. Dividends can be reinvested within these accounts without immediate tax implications, allowing for more efficient growth of capital. When properly planned, dividend growth investing within these accounts can significantly enhance the income available to retirees, reducing the reliance on government benefits and other forms of retirement income. 5. Challenges and risks of dividend growth investing. While dividend growth investing offers many benefits, it is not without its risks. Investors should be aware of potential pitfalls, particularly when chasing high dividend yields. Companies offering exceptionally high yields may be doing so because their stock prices have dropped due to underlying financial issues. In such cases, the dividend may be unsustainable, leading to potential dividend cuts or even bankruptcy. Another challenge is the cyclical nature of certain sectors. For example, energy companies might offer attractive yields during periods of high oil prices, but those yields can become vulnerable when commodity prices fall. Investors should focus on companies with strong fundamentals, a history of consistent dividend payments, and the ability to continue growing dividends in a variety of market conditions. 6. Conclusion: a long-term strategy for wealth building. In conclusion, dividend growth investing is a powerful strategy that aligns well with the American economic landscape. It offers a balanced approach to wealth building, combining the potential for income with long-term capital appreciation. For U.S. investors, sectors such as consumer staples, healthcare, utilities, technology, and real estate provide excellent opportunities for dividend growth.